Well, on open exchange, South African gold miner Gold Fields has reported an 11% decline in first quarter gold production to 477,000 equivalent attributable ounces. The company also saw a total cash cost of $819 per ounce. Joining us now to look at those numbers further and the company and the gold sector is Nick Holland, who is CEO of Gold Fields. And still with us in the studio, Craig Pfeiffer, GM Investments at Absa Investments, and Nick Crail, who is Portfolio Manager at RMB Private Bank. Good morning, Nick Holland. We've got two Nicks in the studio this morning. As I said there, production down 11%. You did say in your statement, as planned, nothing surprising here. And I think the other thing worth mentioning is the zero fatality rate.
Absolutely. The production for the quarter was very good. Guidance for the entire year was 1.825 million ounces to 1.9 million ounces. You can work out the maths at 477,000 ounces. We're going to be at the top end of our guidance then for the year. The costs also below the guidance. We said 860 for the year for cash costs. We're at 819. So I'm very pleased with the set of results. And of course, more than anything else, the fact that we had no fatalities during the quarter. I think that reflects the fact now that Gold Fields only has mechanized operations. We have 9,000 employees that are largely skilled employees around the world. And I think you'll see that coming through in a much more stable and consistent production profile and cost profile.
It does sound strange, doesn't it, in an industry in South Africa where we're accustomed to these huge, hundreds of thousands of miners, to hear that a big company like Gold Fields has 9,000. It just shows where the industry has got to. Just remind us of the Sibanye effect. So where the company is now after the Sibanye listing separately.
Yeah, so when Sibanye listed on the 11th of February and unbundled on the 18th of February, effectively now we don't have Kloof, Driefontein and Beatrix anymore in the portfolio. They were producing around about 1.3 million ounces a year, higher costs than what we've got, and they're now on their own. So effectively we only have South Deep in South Africa, 3,500 employees. That'll go up to about 5,000 employees. And then of course we have our operations in Ghana, Australia and South America, along with a significant growth portfolio around the world.
Craig?
Nick, your South Deep, just looking at the numbers briefly, their production was fairly flat on the December quarter, whereas your other operations, West Africa, Australia, South America, those were a bit lower. Is there a theme? We would have thought just intuitively, South Africa production's lower, and the rest of the world may be holding its own or picking up. What is the story there?
The theme there is that on the international operations, we've deliberately cut back marginal production, which is why the production is down 11%. We deliberately decided to shut down the high-cost heap leach operation at St. Ives, similarly at Tarkwa, and then at Agnew in Australia, we pulled out of the low-grade mining, and we've improved the overall margin. I've been saying for some time, it's not about ounces, it's actually about how much cash we make. And this is repositioning Gold Fields to make cash. Now, fortuitously, I didn't know when we did all of this late last year, that the gold price was going to plummet the way it has. But fortuitously, it actually sets us up very well to withstand these kind of gold prices and even lower gold prices. We're very comfortable that if gold goes down to, say, 1,300, as some of the doomsday analysts are predicting, and bear in mind they've been wrong for 7 years out of 7, then nevertheless, if they are right this year for a change, we're ready to withstand that. So we've got a much more defensive portfolio than what we've had before.
Nick?
Yes, Nick. I understand what you're saying in terms of bringing down the labour that you've got in the relations, specifically into the South African labour market. Obviously, you still have a fair amount of labour, I suppose, in Ghana specifically. I mean, those are your biggest productions are going to be Ghana and South Africa. How do you foresee labour and wage negotiations going forward into the rest of the year? How comfortable are you feeling with regard to that?
Well, first of all, we've got 3,500 employees in South Africa. We used to have 40,000 employees. We've got skilled employees. South Deep is paid more than the rest of the industry because of the skilled, mechanized nature of operations. The other thing is we're ahead of the curve. We put a new operating model in at South Deep in November, whereby we've already moved to 24/7 operations. We put in a new tailored incentive scheme that is almost akin to a profit share scheme. So we've done a lot of work already. But if you ask me to talk as an industry, and we are part of that industry, then what I think we need to do is is come up with a win-win solution. We simply cannot afford to keep paying double-digit wage increases for flat or declining productivity. We simply cannot. I think the unions must realise that by now. Certainly the government does. So how do we create a win-win solution for everyone?
Nick, you say certainly the government does. Is your information or intelligence that government is understanding where the industry is? Because we've said before that platinum in particular, but gold also, the sense that there's this industry that makes all this money and the country isn't getting enough benefit out of it. But it's a moving target. That target was there in 2005-06 with platinum. That target's moved on. Amplats is struggling to survive as a company, let alone windfall taxes. So do you sense that there's an understanding of this? The union's job is to try and get higher wages, but in government?
Certainly from my engagements that I've been into with government along with industry and alone, as early as middle of last year we flagged, now the platinum industry is in crisis and the gold industry is not far behind it. And that makes up 2/3 of the 500,000 workforce in this country. So we're going to have to do something different to make sure that we can survive. And I think government likes the notion of lowering the base wages, but then have a productivity-linked increase beyond that.
But you'd be happy with that, presumably?
I would be, and I think it's also self-financing, and at the end of the day, the employers are incentivized to do better, which is what we need.
Yeah. Nick, you wanted to make another point?
Yes, I think I'd like to make the point that I suppose you're going to be, as you've just alluded to, a lot less exposed to the current wage negotiations that are going forward into South Africa, as you've just explained. So if we have a look, I mean, you've changed your strategy from production, as you mentioned beforehand, to towards, I suppose, cash generation. Can we expect further production cuts to come through? I mean, is there more on the cards in terms of the next couple of quarters?
No, in fact, I think we can actually improve our production, particularly as South Deep increases. What we've done now is we've got a very strong production base on the international operations. And if South Deep can deliver what we expect it to do, then in fact I can see the second half of this year showing increased production. And the thing with South Deep is all of the costs are in the system already for that increased production. The labour's in the system, we've increased the fleet, we've got everything ready to go. The electricity costs we're already paying for. So that'll flow straight through to the bottom line. I'm very comfortable with the way the international operations are set up. Australia, we've done a lot of reorganisation. It's making good money. The Peruvian operation is already a great money spinner for us, and that will continue. And Ghana, we've got wonderful opportunities for us to sustain and expand production. We have 25 million ounces of resources in Ghana, and there's a big portfolio there that we can capitalise on into the future.
Greg?
Nick, we talk about productivity, and it's we'll give you higher wages if you increase productivity. But what does it really mean at the mine? Does it mean the miners have to just dig more rock? That's the bottom line, or is there a limit as well to how much you can increase productivity per person?
But also, just to add to that question, our industry apparently is the only one in the world where you have so many days off, where you don't have continuous working. Now you've moved to that. So there's a lot of space, not just in working harder, but in changing the way people work.
Exactly. South Deep, we've now sorted out that problem. But looking at it from an industry perspective, we could actually get at least another month a year by possibly working the off Saturdays. Typically, we have an 11 shift arrangement, 11 shift fortnight. One Saturday on, one off. Let's work the Saturday on, make sure that that doesn't compromise the maintenance. It gives you an extra month. Now the other thing is, how can we get people into the workplaces quicker? We know that some of the workings underground are much further away, more dispersed. How do we actually get people in quicker? Because in some mines, we only have 3 or 4 hours of effective working every day. Now what can you achieve?
Because they're travelling to where they work for the rest of the time.
Exactly. So we have to find innovative ways of getting people in quicker. And I know that my colleagues in the industry are thinking about this, and it's imperative.
Are we looking at high-speed trains underground?
High-speed monorails.
High-speed monorails. Well, I just want to come back to a more technical thing, and that is you mentioned cash. And you're one of the CEOs who talks a lot about cash, and you have this measure called notional cash expenditure, which doesn't crop up often, NCE, operating costs plus capex. And you say that expenditure was down. So that's clearly a key measure for you.
Very much so. And I'm very pleased to tell you that in the World Gold Industry Forum, I believe that we've been instrumental in Goldfields in getting everyone now to consider adopting this measure. And as we speak, the CFOs of the major gold companies are drawing up a new basis of reporting all-in costs.
Did you invent this, being an accountant?
Yes, I'd like to take credit for it, but I see now that my colleagues in the other gold companies are claiming credit for it, and I'm delighted because that means that everyone is going to drive it. I really don't care who takes credit for it as long as we do it, because the one thing is clear in this industry: if we do something well but everybody else does it badly, it won't help us, because people take a sector view. As these gentlemen will tell you, people take a sector view on the gold industry. So it means that the gold industry internationally has got to do the right things. I think we're all moving in the right direction. Projects are being curtailed all over the world. People are starting to focus more on cash. And maybe we can get some investors back into the gold stocks and out of the ETF, which is our main competition at the moment.
Nick, did you have any further point there?
I suppose I'd just like to discuss Ghana. You know, there's obviously been rumours for a while about their potential increasing the tax situation there. Is any sort of further news from your side on that, and what's your feeling?
Yeah, I've just spent a whole week in Ghana last week, so engaging with a number of people in government and the workforce, and they are very keen to find a way to encourage investment into the country. They're sitting with a situation where their fiscal deficit has grown significantly. They need to attract investment. Their sovereign rating has been impacted. So they're keen also to find win-win solutions. And I've told the government we will invest in the country, and I want to work with government to create the right environment. They in turn have indicated that they're going to look at all of these stability agreements in the country at present. We don't have one. Certain other gold companies do. And try and create a level playing field which would be fair to all of the companies, and I'm encouraged by what I hear.
Craig?
Nick, just to come back to that NCE again, excuse me, you got it down to $12.91 in this last quarter. Where is the industry? Where the local industry? And would that mean that, you know, below that level of costs, you know, shafts, mines become unprofitable and we start losing more ounces? Where is that benchmark?
Well, let me tell you where the global industry is first. The global industry at the moment is around about 1,450. So what is the gold price at the moment? About that. So what it's telling you is the gold industry internationally, about 68 million ounces a year of production, is only able to cover their operating costs and their capital expenditure. That means they can't fund growth, they can't fund taxes, they can't fund royalties.
Because as you say in your measure, that it's operating costs plus capex, and then what's left after that is for all the other things that you have to do, like tax and interest and debt and dividends, which investors are obviously interested in. Nick, the other thing I wanted to ask you was that it seems like yesterday that you took over from Ian Cockrell at Goldfields. It's a few years now, isn't it? How long is it?
5.
5 years, yeah. But you're now, aren't you the longest serving, certainly of the big companies, because Mark Kutufani's gone from AngloGold Ashanti. There's a new guy there, Venkat. I can't say his long name, and he doesn't mind that. But it was interesting. One of the analysts said that, Peter Major, I think it was, he said he would rather have seen an engineer in charge there, not an accountant. So I thought I must put this point to you, because you were the chief financial officer at Goldfields before you came CEO.
Those kind of comments don't bother me at all. I believe that I understand this business as well as anybody else in the company, and I spend a lot of time making sure I understand the operations, and the proof is in the pudding. You know, whether or not we can deliver the results is what counts. It's not who's at the helm.
But perhaps another way of why I put that point at the beginning is that being a long-serving CEO, you've been around, you've seen the industry through tough times. We would like to think that you'd stay around in terms of the industry in South Africa, even though the focus of Goldfields is now substantially elsewhere.
We are a proudly South African company. We have to remember, you know, we are listed here, we're domiciled here, we're headquartered here. That's not going to change. South Deep represents the biggest single growth opportunity for the company. We've invested over 35 billion rand in South Deep, and that's going to be around at 700,000 ounces a year circa for 50 years when we get it to full production. So it's going to be a significant part of our NAV going forward, but I'd like to think that we can grow the company into other jurisdictions, and that we can deploy some of the skills and resources that we've developed in this country. And we've certainly moved people around the world in that particular objective. So proudly South African, we're still here.